Good. Hello.
Okay. Hello, everyone. Welcome to the 2018 year-end update. We are delighted to have our stakeholders joining from Australia to India, to Hong Kong, to Middle East, and UK. 2018 was a tough year for all asset classes, and fixed income was no exception. It provided a perfect backdrop to demonstrate a deep understanding of credit markets. We outperformed not only our peer group, but also the indices without any drift in our strategy to focus on investment grade short duration bonds. Now I would like to invite Mr. Sanjay Kulkarni, CIO of Silverdale Capital, to take you through the review and also highlight what we anticipate for 2019. Sanjay would like to make it an interactive session, so after he presents, the floor would be open to questions. May I request you to use the hands up option on Zoom or simply raise your hand so that we can unmute and take the question. Thank you very much.
Thank you, Mohini. It's indeed a pleasure to present the Silverdale Bond Fund presentation for year 2018. Very personal thank to each one of you who have taken time to be on this call. We appreciate your support. It's your support which makes us going. Thank you very much indeed. I am assuming that you are able to see the presentation. Should anybody have any problems, please do raise your hand or let the coordinators know about it. We know our performance in the Q3. In terms of Q4, it was down by about 1.6%. And as you know, we pay a dividend of $2 per share. For the year 2018, we had paid a dividend of $8. Our fund was down by 8.28% after paying dividend of 6.62, which means net to net basis, we were down by about 2.2%. Importantly, the quality of our portfolio was marginally improved from 78% to 79%. We had significantly reduced the duration from 2.14 years to 1.65 years. Consequently, the coupon increased, but more importantly, the leverage return increased very significantly from 6.72 to 11.65. As I go further, I would be explaining in more details exactly what happened and what we anticipate in future. I'm delighted to share that despite the tough year, and as compared to our peer group, which lost typically between 25 to 40% of the assets, our assets actually grew by 24% year on year. And I thank each one of you for your consistent support to the fund. Thank you indeed. In terms of performance, since 2013, about five odd years, we are giving you about 50% return as compared to the index, which has given 20% return, and the peer group, which has been even lower. This demonstrates the fact that despite the tough market conditions, we did pretty well. So if you notice, their walls are much lower as compared to many of our peer group. Put in number, we gave a return of 7.8% return in the last 5 years. Our duration at 1.65 is one of the lowest in the industry. As compared to index, just to remind you, we are talking about JP Morgan Emerging Market Corporate Bond Index, and we take an ETF as a proxy for it, which gave return about half of our return, which is roughly about 4%, and duration, which was more than 2.5 times at 4.85 years. As you know, we are primarily into investment grade bonds. The quality of bonds marginally improved from 78% to 79%. We continue to manage it very dynamically. In terms of the duration, again, very actively managed, as you know. The 60% of the portfolio continues to be less than 2 years in terms of duration. That's primarily because of increase in the securities in 0 to 1 year bracket. So as you notice, it has moved up from 26% to 37%. Approximately 15% of our portfolio continues to be in terms of floating rate securities. Geographically, we continue to be very well diversified. The number of countries have increased marginally from 19 countries last year to 20 countries this year. Our number of securities have marginally increased from 114 securities last year to 118 securities this year. Turkey was the single largest contributor to our results. You remember our CIA letter, which I wrote to you at the height of the Turkey problem, explaining to you why we still like Turkey. The reduction in Turkey exposure, which you see, is primarily because of the runoff of the bonds. The duration, just to remind you, at the time of peak was 8.8 years. Today is about 7.2 years. We continue to see value in Turkey. We are deeply cognizant the fact that they had 2 huge quarters of surplus. The inflation continues to be high. The growth rate is still too high, and therefore, going forward, we need to be careful. We are cognizant of that. At this data point of time, Turkey represents significant value. The reduction in Brazil and in US from 27% to 21% for US and from 13% to 8% in Brazil is primarily again because of the buyback stroke maturity of bonds. Thailand, the key addition in Thailand has been PTT, and as I've shared with you earlier, PTT is the largest oil and gas company in Thailand, with debt to EBITDA ratio of close to 1.1. Very well very well cash-rich company. We love the company. It's a short duration bond which we hold and is largest holding for us. Russia, which you see, is primarily in terms of exposure to Lukoil and to Alrosa. Lukoil requires no introduction. It's one of the most solid names in the oil industry, one of the largest reserves in the world. Significant portion of the assets are outside Russia. Alrosa is the second largest producers of rough diamonds in the world. Again, investment grade company. We love that very much. In terms of the others, 18%, this represents about 12 countries, and they include France, Qatar, UK, Norway, Canada, Luxembourg, Switzerland, Indonesia, Netherlands, etc. So again, a very well diversified portfolio, which helps us to benefit from the volatility in the emerging markets. In terms of sector, as you know, 2/3 of the issuances are from the financial sector, where the strategy we try to keep finance lower in order to reduce the vols. Our exposure to financial has increased marginally from 38%, and our exposure to technology has been reduced, primarily because of the buyback of Western Digital. Energy exposure has increased primarily because of Lukoil and Reliance Industries, both of the securities which we increased in 2018. As regards leverage, we continue to maintain low leverage, around 60% plus minus 3%. It is still lower than the median leverage we deploy, which is 65 to 70%, partly related because of the fact that we are able to get our desired returns without the requirement of increasing the leverage, and therefore are able to reduce our vols still further. We continue to be prudent in terms of leverage and don't see any reason to change from that. The next slide, slide number 12, is the single most important slide from the investor's perspective. We have always maintained that increase in the interest rate is a good news for the civil bond fund. And as you see, 1% increase in the Fed rates have increased our returns, YTMs, by 2.27% from 3.95 to 6.24. More interestingly, the leverage YTM has increased by 4.9% from 6.7% to 11.6%. To be honest to you, this is much more than we expected it to increase, which is a good news and not so good news. Good news because going forward, the portfolio will give a fantastic return in terms of the yield to maturities. Not so good news in terms of 2018, we have given you a negative return of -2%. I'm delighted to share that as we talk, we have almost bridged the gap. We are up by about 1.93% as I talk to you today. To give you a perspective in terms of month-by-month return, we have been 68% times up month, then down month. When we are up, we're slightly more up. Therefore, the reason for our performance. This is from your Communique, which is shared with you every week. As you notice, we are managing about $700 million of the book, out of which $427 million are investment. Balance being, of course, the loan taken. In terms of investment, we have net asset client equity of $152 million, the balance being the loan taken by us. I also want to highlight to you the fact that our yield is 11.65% with duration of 1.85 years. We continue to have best of the breed holdings, which is PTT, we discussed, Crédit Agricole, which is largest bank in France, Scadel, which manages close to about $300 billion in terms of assets on the private equity hedge fund managers, Seagate, hardest producer, Braskem, third largest polypropylene, Ziyad Bank, largest bank in Turkey, Tibu, one of the largest trading group in China, Qatar National Bank, one of the safest bank in the world, Vedanta, very well diversified conglomerate, DNB, the largest bank in Norway. So on the whole, excellent quality of portfolio. I was referring to this number. So the trailing 12 months as on 28th of December was minus 2.2. We already recovered 1.93 out of this. So we are almost at quits. As compared to our peer group and the indices, last year we down by 2.2. The index was down by more than 2.86. Franklin, for example, was down by 5.5. Alliance was down by about 7. The interesting portion also is to note that our duration is one of the lowest in the industry. And when you see people like Templeton having less than us, it's primarily because they are long short, which we firmly believe is not the best way to look in terms of emerging market credit. In terms of the 2008 in summary, so basically we have outperformed both the indices as well as peer group. We paid you $8 per share in terms of dividend. There's been no strategy drift. We continue to be focused on IG bond, short duration. We still benefit from economies of scale in terms of initial cost of leverage, low brokerage, practically zero custody, and our world-class risk management. As anticipated, a 1% hike in Fed rate has increased our return by almost 5 times more, by 5%, which is very good. To conclude, we never got a margin call, and we don't anticipate any margin call despite being internally leveraged, among other things because of the fact that roughly about 50% of our portfolio stock cash would be maturing in 12 months. Now we keep a headroom of 10% circa, high quality bonds, minimum 75%, low duration, below 2 years, very well diversified, around 120 bonds, and the proof of our proprietary cash flow model, which is we have 20 cases wherein there is a credit upgrade stroke buyback with the companies. These opportunities, which are huge, so 20 out of 120 or what you look at it, we're talking close to about 18% of a portfolio getting upgraded is fabulous track record, and this is what gives alpha to your fund. To summarize, we're talking about a portfolio with the leverage return of 11.65% and duration of just 1.65. So the magic numbers for you to take home are 11.65% leverage yield and 1.65% in terms of the maturity. Thank you very much. I appreciate your time, and I now open the floor for the question answers. So please go ahead.
This is Nidhi from Kotak. We just wanted to know what was the reason for what was the major detractor of your returns? What dragged your returns down? Which country and which bonds?
On the whole, it was broad-based, nothing in specific. But if I was to pick one country and thing, the largest drag in terms of geography was in terms of China and India. But as I mentioned to you, not a major one, but yes, they were the largest country drags out there. The positive were number 1, Turkey, and number 2, Brazil. In terms of bonds, nothing specific which comes to the mind. Yes, Vedanta was a bit of a drag, but as I mentioned to you, like 0.1%, etc. is not really significant. So in terms of drags, there's nothing significant which is there.
Vedanta was the biggest drag, is it?
As I mentioned to you, this is asked a number. I had to give you a number, but Vedanta was contributed almost 0.120% in terms of the drag, which is not really significant because.
Then with leverage, it will be more, right?
Yes and no, because in case of Vedanta, the leverage is much lower. I won't know exact number, but I would be surprised if it is more than 30% leverage.
That means it's quite broad based. Many bonds, because if Vedanta alone is the biggest detractor at minus 0.2%, and your overall drag is minus 2.2, that means there's many bonds where there is a negative return.
Yes and no. So let me put this way around. Unlike in case of equity, where over diversification draw is much higher, in case of fixed income, a diversified portfolio typically will give you superior risk-adjusted returns. As you know, the entire market had issues because of several reasons. Most important being in terms of the increase in the credit spreads, which is a classic thing which happens in case of the last leg of the economic expansion. So that's something which was expected. So there's nothing to be concerned, worried, or to go across of that. The fact that the losses was widespread, it seems to be bad news, but technically it's good news. It also means that you require about 100 plus bonds to lose very minor amounts to finally club up to become a minus 2% fall as on 28th of December. And as I mentioned to you, partly, of course, also because of the fact that it's a year end. So as I mentioned to you, we have already recovered 1.9% out of it. So we are talking about now something at 0.2% fall, and 0.2% fall over whatever name you will take, 80 names, 100 names, we're talking 0.002% in terms of portfolio impact. So I think it's not a material amount.
Okay, thank you.
Hi Sanjay, this is Shantanu from Bank Muscat.
Hi Shantanu.
Yeah, I have a couple of questions. Firstly, on the interest rate side, I would just like to understand your view. How do you see interest rates shaping out from here? If you can just put some color on that.
Sure. So in terms of the Fed rate, if that's a question, as you know, the market is pricing it 0 rate hikes from here. Fed is indicating 2. We believe it should be between the 2. Couple of points there. First and foremost is that we don't see any signs of recession happening in the near term. And there are about 7-8 key reasons for it. The most important reason is that the unemployment rate is far lower than what it should be. Typical unemployment rate in US, we would estimate to be around 4.3, 4.4%. Today we're talking about 3.3, 3.4%. So the unemployment rate is too low. When the unemployment rate is low, it leads to consumer confidence and certain amount of wage inflation, which is very painful to go away. But it also leads in terms of certain amount of consumer behavior, which will keep up the engines running. Therefore, in terms of the pure classical monetary policies, we should look forward to 1 rate hike. Having said that, in terms of what's more important for us and for larger case in terms of credit investors is that while the rate hike is one of the factors, but the more important, bigger factor is that the secondary impact is which is increase in the credit spreads. 2018, the key problem in 2018 was increase in credit spreads. 2019 also would have certain amount of pain continuing. And if the market has got it right, there is a recession, this will become much more acute going forward. So from the investor point of view, our take on the interest rate is that we are into a better position as compared to 2018, and which is also reflected in terms of how the bond markets in the portfolio is performing. But we would always be alert, given the late cycle, that we could look in terms of credit spread increasing. And therefore, we would stick to high quality bonds, which would at least tend to gain late in 2020, 2021, when there will be more flight to safety.
Sure. So just to understand it clearly a bit more, so what we are saying is that maybe going forward we may see more risk coming from say credit side, credit spread side rather than interest rate side. Is that correct?
You are correct. With one more caveat, you are 100% correct what you took. Also, in terms of credit spread widening, the lower quality of credit will see much more widening than the good quality. Good quality would start actually be constant or get tightened in about a year and a half from now. So obviously the path will begin.
Sure, sure. I have one more question, if I may. I mean, this is also related, somewhat related to the first question regarding the interest rate increase going forward. I mean, I think you mentioned that currently the fund has roughly 15% investment in floating rate securities.
Yes.
So I would like to understand what kind of returns are we getting on these floating rate securities? Say over last 1 year, what is the return we got from these?
So in terms of the floating rate, of course, return-wise is fabulous. The key thing from the investor perspective, as far as the bond fund is concerned, is because the fact that many of these floating rate securities which we have were five-year securities. So in this year, we would see significant portion of these floating rate securities being referenced to 3-year CDS rather than 5-year CDS. So there's an uptick which will come to the portfolio when the reference CDS moves from 5-year to 3-year. And depends on the of course the underlying, you should see a uptick of between 20 to 60 bips. So if I take a 40 bips, multiply by 3, we're talking about 1.2 points appreciation in terms of the prices for floating rate securities. Your earlier question was
so what kind of return it would have given, say, in last 1 year, say, of a floating rate security? Say, I'm assuming this is a fund, say, floating rate bond fund. So, what kind of return it would have generated?
See, it's, as I mentioned to you, it's a bit difficult to give one name by name, but I give you a range. So we're talking of something like 15%, 12%, 16%, 10.5%, 17% sort of handle. That gives the color to you. These are all yield to maturity, just to remind you, leverage yield to maturity.
Okay. Okay. Why I was asking is basically, I mean, now that we have a view that, say, going forward, interest rates may not increase at the pace what it has been, say, over last 1.5 or 2 years. So, what's the reason that we think that we should be investing into floating rate securities, because we may not be getting benefits of higher interest rates going forward? So, are we maybe?
Yeah, few points. First point is that on a standalone basis, where we stand today, anything with the handle of teens is a good handle to hold. So purely from where it stands, it makes sense for us to continue to hold. But the other point is, as I mentioned to you, a significant portion of this portfolio will get remarked this year from 5-year CDS to 3-year CDS, which basically means I'll have about 1.5 points uptick on the portfolio. Another reason to continue to hold. Cash flow, again, cash flow wise is fabulous to hold because it gives a good about 17-18% on equity in terms of cash inflows. Then last question is in terms of, if I don't see increase in interest rate, why do I still continue to hold? Besides the reason which I mentioned, the 3 reasons: return, floating, in terms of the markup. The other thing to keep in mind is in the relative return. So we are a relative value investor in the sense of the word. If we see a better opportunity, of course, we would move to other bonds which give a better return to us. So we are not ready to it, but at this point in time, I think this represents sufficient value, specifically because as the credit spread increases on the low quality, the high quality would not suffer that much, and it may even tighten a bit. So we are we can rest assured that we are keeping them in a close watch, and we shall act in case we see any better opportunities in the market.
Sure. That's fine. I'll get back in the Q&A and come back with another questions later. Thank you.
Thank you.
Hi Sanjay, I'm Shravan this side.
Hi Shravan.
How are you? Thanks for the presentation and for the satisfactory results.
Thank you very much for your support, Shravan. Appreciate it.
Thank you. I just wondering, of course, we touched base on the leverage. If you can give a little insight on asset-based leverage at the position level and on the fund, at the fund level. First thing. And second thing, I wanted to touch base, again, we had some conversation regarding performance contribution. So if we can give heads up regarding the currency contribution, say contribution coming from dividends, from bond returns.
Okay.
If you have any breakup here.
So in terms of the returns, it's a pretty well diversified, and it's difficult to give one name. A country that we already shared with you, but in terms of the bonds which contributed positively, of course, are basically more in terms of the Turkish bonds. Ziraat Bank, for example, was one of the largest contributor. East Bankasi was a contributor. PTT was the contributor. Incidentally, these all contributed. Each of them was around 0.2, 0.3. So Garuda was a contributor. Garuda is the largest producer of steel. As you know, we had a reasonable exposure against it, and they did a buyback, so we got extra monies there. But otherwise, it's been pretty broad-based in terms of our positive contributors. In terms of the contribution of the currency, answer is zero, because we don't take any local currency risk whatsoever. And rest assured that we would never do it. So we are very clear that neither we intend to take any local currency exposure anywhere across. So contribution from currency would always be zero for us. And we believe that in terms of the current economic situation, even if we had an opportunity, we would not go beyond US dollar, given the position of US dollar today, US as an economy, and if there was to be recession again as a safe haven. So that's what it comes across with that. Coming to in terms of the attribution of our returns, how much comes from where, it's a bit difficult to give you an exact breakup sector out there. But broadly speaking, we had 20 buybacks rate upgrades. So if you look in terms of the buybacks, 11 buybacks, which is on the screen now. So typically, in case of buybacks, we have typically seen to get an uptick of 1 to 2% on the lower side, to almost, as I said, about 2.5–3%. I would say that the median will be around 1.5 to 2. So even if I take 1.5, so 11 bonds out of say 120 bonds, we're talking about 10% of the bond getting upliftment of about 1.5 points because of buybacks. So that is this colors to you in terms of buyback, which we're talking about. In terms of the bond maturities, the sector out there, look this way around, we will have about roughly about 5%, 4%, 5% maturing every quarter. So if you look in terms of rolling down the curve, we should look at around between 20 to 40 bips. So even at 20 bips, we're talking about 20 bips and 25% of the portfolio benefiting in terms of rolling down across the board. I would say if I were to pick up one thing which was largest contributor is what is always there for us, which is basically in terms of the trade selection. and that has been the largest contributor for us. And the reason why I say it is because if you compare our returns with the indices, you will see a very poor correlation, and also in terms of the exposure we have as indices, you will see a poor correlation there.
Thank you. Yeah.
Thank you, Shivan.
Yes, another was I was asking about fund level leverage and the asset leverage.
Pardon?
Another question I was asking about the leverage.
So on an overall basis, as you know, our leverage is around 63%. It's like a couple of percent up and down is very difficult to quantify, but what I can assure you is that we don't see a major change happening from here. Historically, our leverage is 65 to 70% for each $100 out of $100, depending how you count it, maybe 2.5 times. In that context, it's slightly on the lower side. In terms of the breakdown further, typically IG bonds gets you a leverage of about 75%. So we would take around 65 there, and the non-IG would get within 40%, something around that. We get 80% there, so weighted average will become around 63%. Is that okay? You want anything more granularity there?
All right, for now, I'll come back with the more questions if I have. We can touch base. I thank you and appreciate the presentation and your support.
Thank you, Sharon.
Apart from हमने 3-4 year रखे ना हमने, there's no balance, you know. कभी
तो शीशे मैं कौन धोने का बेचता हूँ.
Are there any more questions?
So let me summarize to you in terms of.
Sorry, Sanjay, hi, can I ask a question?
Please go ahead.
Thank you very much. Sanjay, same question I ask over and over again, but in a slightly different way. And it's the question of having your leverage providers pull the leverage. And I know you addressed that at the end of your presentation where you said they will probably not do that because 1 year, because 50% of our portfolio will mature within 1 year. The question is, have you been given assurances by your leverage provider that as long as you follow these certain metrics, i.e. duration and investment rate percentage, that they will not pull leverage? Have there been assurances provided for that?
So let me clarify this. One is that, is there any assurances? The answer is yes. Is it any worth the paper is written on? The answer is no. And the reason is straightforward. 2 reasons. A legal reason is that the ISDA documentation is very loud and clear that any company in the world has a freedom to do or not to do business. So we cannot compel any institution to do business. The more important thing is this, that if such eventually happened, what will happen to us? The answer is that the way we are paranoid about risk, we have already considered this risk because we have seen from our experience every 3 to 5 years, every large bank in the world would change its strategy. And in 30 years of my profession, I haven't seen any decade where any bank in the world hasn't changed strategy. So I would not be surprised if some bank was to pull out. We have already faced this twice earlier. Early when we started the fund, when Barclays quit Singapore, and second time when ABN AMRO changed strategy for Asia. It doesn't bother us beyond the point because as we stand, we have lines from multiple lenders. If the lender wants to withdraw line tomorrow morning, we are happy to move it to some other lenders. We always keep sufficient, credit lines for us to take care of such an eventuality. Is that okay? You want me to elaborate more? I think we lost him. For the benefit of the investors, let me clarify that we have credit lines from primarily from 4 large institutions. The biggest credit line, of course, is from Credit Suisse and Bank Julius Baer, but we also have from other banks. We have sufficient credit lines that if any bank was to withdraw or should pull their support, we would be able to move our assets to other bank and without any damage to our strategic stock portfolio.
Sanjay, hi, Jomi here.
Yeah, please.
Hello, Sanjay.
Hi, I can hear you. Please go ahead.
Sanjay, I don't know whether I missed it out. In your bond portfolio, the full exposure is in US dollar, or you have cross-currency exposure as well?
Apologies, Noli. Can you repeat the question? I couldn't understand.
Sanjay, do you have any cross-currency exposure other than dollars in your portfolio?
The answer is no.
Okay.
We have zero cross-currency exposure in terms of any non-US dollar securities or whatsoever it might be. Let me clarify again to you that we don't buy local currency bonds and would do swap across out there, because we would end up doing a naked in terms of the coupons, which are difficult to manage a sector out there. Theoretically speaking, if there was to be a zero coupon bond, of course we can look into it. Since the fund was done, we have done about a few transactions where we could get it convert a local currency bond into a credit note sector out there. But as far as the fund is concerned, we would not take any direct or indirect currency risk.
So it's all 100% dollars.
100% dollars.
One more question. What percentage of your portfolio is more than 5-year maturity bonds?
How much is?
More than 5 years maturity bonds in the portfolio.
Oh, more than 5 years is hardly anything. Just give me a second. Which is 1%.
Well,
1 second. Apologies. Above 5% is 0. 4 to 5% is 2%. Above 5% is 0.
Okay. Thanks, Sanjay.
Thanks, Noli.
Are there any more questions for Sanjay?
Well, if there are no more questions, let me conclude by 2 things. One, of course, is to assure our stakeholders that, please go ahead. Is there a question there? So if there are any questions, I would request you to kindly drop an email or feel free to contact us, and we'll be delighted to revert back to you on those. For others, thank you once again for being on the call. Let me assure you that we continue to be focused in terms of our strategy. The magical words are indeed the 11.65% YTM and 1.85% in terms of duration. Should you have any concern on any particular thing, do let us know. But we are fairly confident of two things. A, the performance of 2019 shall be better than 2018. And number two, with your support, we shall be able to increase our assets further. Now I hand over to Mohini to close the call, please.
Thank you, Sanjay. Thank you, everyone, for joining us on this call. And again, we take this opportunity to thank you for the support and wish you a very, very happy and a prosperous 2019. Thank you so much.